There are thousands of stocks to choose from, and day traders or swing traders can pick any stocks they want. However, the first step for a trader is to figure out what to trade. In today's video, I will share several tips on how to select stocks for intraday and swing trading in order to identify the best trading opportunities. Your role as a trader or investor is to filter through the noise of markets and select the best setups. This may sound complicated, but the process is painless once you know how to start. Every good scan starts with the proper scanning criteria. First, let me start by saying that there is no perfect scan, as all traders have different styles and strategies. This is my own way to pick stocks to trade for swing trading. That said, once you understand how these filters work, you can begin creating your own scan, one that will work for you. So here are the filters I use. First, the average daily volume over the past 50 days must be at least 1 million shares traded. There are several reasons why the daily average volume is the primary factor for my stock selection process. The first is liquidity. Your stock must have sufficient intraday trading volume. Any stock that is trading under 1 million shares can be easily manipulated by market makers, and they usually trade very slowly. Think about it in this way. Do you really want to be trading a stock that Wall Street obviously wants nothing to do with it? Remember, low volume means low interest in the company. A low volume traded stock simply means it's not worth trading. Low volume stocks tend to be extremely speculative and unpredictable. Because there is such a limited number of shares, a large purchase by a mutual fund or another big investor can cause a huge spike in the price. Or if the investor decides to sell, the share price will likely tank. Neither scenario is ideal for us small players. That's why I avoid stocks that trade fewer than 1 million shares per day, based on the 50-day average. Next, the stock price must be minimum $50. Both volume and price are key factors that help fuel big moves in stocks. I personally tend to avoid penny stocks and prefer to stick with stocks that are priced over $50. The triple-digit stocks are even more suitable for day trading and swing trading. Why? Because the stocks in this price range are the most highly traded stocks, but also have the largest volatility. One of the most consistent mistakes a significant number of beginner and inexperienced traders make is to be drawn to penny stocks. Consider penny stocks as any instrument that trades for less than $5 per share. At first glance, penny stocks may seem appealing because they tend to fluctuate tremendously in price in very short periods of time. In theory, you could generate a very high return quickly. Unlike stocks over $50, which enjoy deep liquidity, some of these companies might not have any buyers or sellers for days at a time. If you were to build a position at $1, for example, then go to sell it at $2, there might not be any buyers. You could put in a sell order, and it would just sit there day after day doing nothing. That's why I recommend avoid penny stocks, especially if you are a beginner, and stick with stocks that are priced over $50. They will have consistent volumes, consistent liquidity, and most importantly, are consistently traded by Wall Street. Next, use the ATR to assess volatility. Another important factor you should analyze before entering the market is the daily trading range. Some stocks exhibit a relatively small trading range, which makes them not suitable for day trading. A stock goes through different cycles, and every period of low trading ranges at one point will be followed by an expansion period. So if today your favorite day trading stock has a low ATR, maybe it's best to simply wait for another day to enter the market, when the trading conditions are more favorable. As a day trader, the ideal periods to enter the market is when the ATR shows expansion periods in the daily range. Let me show you a simple way to determine if a significant range expansion is taking place. Based on my backtesting results, the ATR reading will signal a significant increase in the range once it breaks above the 100-day EMA. Simply attach the 100-day moving average on the ATR indicator. In this way, you'll easily see if the average intraday price swings are sufficient to trade. For better and faster results, you want a chart pattern that is consistently fluctuating intraday. Your stock should be moving for you to book some profits. The average daily range is another great metric for measuring volatility. Traders want to find stocks that have a high price range, making for more trading opportunities. The idea behind the average daily range is that each market has its own personality when it comes to how far it travels in a single day. The daily range is calculated by taking the difference between the stock's daily high and the daily low. You want that number to be high. For example, if a stock has a 50 cents range every day, it would be difficult to place profitable trades without large sums of money. On the other hand, a stock trading in a $5 daily range would provide plenty of opportunities. So a correct analysis of volatility is an extremely important element when choosing which stocks to trade. Next, narrow spread stocks. Like any other marketplace, there are two sides to every trade, a buyer and a seller. A buyer submits a bid, which is the highest price they are willing to pay for a stock, while a seller submits an ask, which is the lowest price they are willing to accept. The difference between the bid and the ask is called the spread. Beginner traders don't usually pay too much attention to how the difference between the bid and the ask of a stock affects their profit. Large stock spreads can damage your profit potential. That's why you need to choose stocks that have narrow spreads. The spread is a byproduct of the daily trading volume. Naturally, stocks with large volume will positively influence the spread. More liquid stocks, those that trade more often in higher volumes, will have a narrower spread. Low volume stocks can exhibit very wide spreads that have the capacity to wipe out the profit potential. So before going long on a stock, always make sure that the difference between the bid price and the ask price is narrow. With the volatility in the stock market, the last thing you want is high fees cutting into your gains. Next, there must be no current news headlines that affect the stock. If your stock is constantly in the news headlines due to a major economic issue taking place, then don't trade it, wait it out. Stocks that are consistently affected by news tend to be highly volatile, and they tend to have very unpredictable charting patterns. If you are a beginner, don't try to anticipate the market reaction to big events. I can tell you from personal experience that the market often does exactly the opposite of what you think it should do. As a beginner, you're supposed to be avoiding the noise. You can very easily get sidetracked and stumped by the news that are currently affecting your stock intraday. Of course, you cannot completely avoid the news as a trader, but you just have to learn how to navigate around the news, which is usually much easier than trying to directly get involved into news trading. Next is the earnings per share growth. To assess your chances of picking a good stock to trade, I like to take a close look at its fundamentals, especially its earning per share growth. If you day trade, you could skip this, but if you are a swing trader like me and prefer to go long on stocks, earnings per share growth represents an important number. So to find good stocks to go long, seek outstanding profit performance. You can easily calculate earnings per share. Simply divide a company's net income by its number of shares outstanding. Specifically, stocks with earnings per share growth rates of at least 20% compared to the previous year suggest a company that has products or services in strong demand. It's even better if the earnings per share growth rate has been accelerating in recent quarters or years. Strong earnings growth is essential to a stock's success and has the greatest impact on its future price performance. Next is the day highs and lows. When a stock makes a major move up or down following a period of consolidation, it's called a breakout. Breakouts are prime opportunities for traders because a stock has the potential not only to make a big move in a short period, but also to continue the directional move by gaining momentum. Incorporating day highs and lows into your scanning process can help you to find stocks that are breaking out. For example, if you want to find shorter-term breakouts, you may look for stocks that are trading above their 30 days highs. For a medium-term breakout, you may analyze stocks that are trading above their 90 days highs, or you can look for stocks that have reached their 52 weeks highs. Next is the 200 moving average on the daily chart. The 200 moving average is widely used by traders because it is seen as a good indicator of the long-term trend in the market. If price is consistently trading above the 200 moving average, this can be viewed as an upward trending market. Markets trading below the 200 moving average are seen to be in a downtrend. One of the easiest scans to incorporate with the 200 moving average is to view the market in relation to this line. Traders commonly do this to analyze the general market trend and then look to only place trades in the direction of the long-term trend. Also, there must be no stocks affected by frequent government regulations. If the stock is affected by government regulations or approvals, I don't trade it. Great examples of stocks that usually are very risky to trade are biotech stocks and military defense stocks. These stocks tend to move even 50% in one single day when the news hit the wire, whether it will be the FDA approving or declining a new product, for example. You never want to deal with this kind of volatility and uncertainty, especially if you're just getting started. If you learned something new and found value, leave us a like to show your support, subscribe to our channel and click the bell icon to stay notified when we release new videos. Until next time.